Hi, I'm Jain, founder of ActiveAllocator, a digital asset allocation and portfolio construction fintech. I've been thinking for many years about this concept of convergence, the crossing over of hedge funds into private equity space and vice versa. And this seems to be happening now more than ever, especially in New York City, right behind me, especially in big platforms. This is very pronounced where the lines dividing fund managers shrink. And that's when a firm embarks upon to become a comprehensive multi-asset manager, one that invests across public securities, private securities, commodities, real assets, and other hard assets, loans, leases, etc., etc. So a multi-asset manager is different from a multi-strategy hedge fund. A multi-asset manager can be both multi-asset and multi-strategy in nature. And the movement to multi-asset management, I think, may be the next dominant trend, for it brings a bunch of benefits. And some that come to mind are, well, first is a much larger opportunity set to select investments from, a significantly larger canvas of opportunity. Just as the multi-strategy hedge fund may have an edge over the single strategy manager in finding attractive investments. Second is horizontal breadth. There are going to be times when a particular asset class is significantly cheaper than other asset classes. And well, there'll be other times when it is more expensive. So a multi-asset fund has the ability to play when the asset class is compelling and the option to step away when it is expensive. The single asset fund, by definition, does not have the option to dynamically move between asset classes. Of course, can one fund master all asset classes equally well? That's an important question. If not, the logic breaks down because the advantages of multi-asset management may be undermined by shoddy investment selection. Third is time horizon, which is frequently longer than that appropriate for a typical hedge fund. Monthly, quarterly, or annual liquidity schemes generally do not fit with such firms. A multi-asset firm or a fund will require a longer hold on capital as well, and this longer time horizon dynamically expands the range of investments that a manager can consider. Some types of investments do not make sense as one-time bets, but are very compelling from a probabilistic standpoint when made as a series of investments over time. Fourth is marking to market the portfolio in addition to illiquidity. Unless a hedge fund has a side pocket, the difficulty of valuing longer term assets, their hockey stick nature of returns, no change in value and then a sudden major revaluation, and the dilutive or windfall impacts of investors moving in and out of a fund makes a hedge fund typically an unsuitable vehicle for making such investments. The fifth thing that comes to mind is diversification, and the benefits are lower risk and volatility. A multi-asset firm that can invest in comparable return opportunities across an array of asset types, the positive and negative forces impacting sentiments of public security holders, have different impacts on real estate, on commodities, on loans, on intellectual property and privately held businesses. So the different peaks and valleys of these different asset classes smooth the performance of the overall portfolio. Sixth, I guess we are on number 6, are synergistic investment effects of a multi-asset approach. Many synergies flow from having in-house expertise covering all asset classes. So in other words, a multi-asset firm may produce higher returns than just summing up the returns of separate funds covering those same asset classes. Seventh is multi-dimensional opportunities. So we know in investing, investment opportunities do not always neatly fall within one asset class. Some of the most undervalued situations arise because an amalgam of assets are involved, covering a variety of categories requiring valuation techniques from I guess many different disciplines. So this also speaks to talent development within the firm. A multi-asset firm provides the investment manager the platform to apply talent built in the public markets to private assets, skills that a typical private equity or real estate specialist does not possess. Hedging, trading, and risk management expertise can benefit private assets too, not just public ones. The ability to move quickly, having in-house expertise for all assets, all asset class positions, the multi-asset firm to move more quickly than others in pursuing an opportunity. And these days, it's an edge that can be critical when you have short deadlines. So seizing and creating attractive opportunities is paramount to generating returns. And with it comes economies of scale. The more capital an investment firm can manage without degrading the attractiveness of the assets it acquires and manages, the greater the benefits that firm can bring to its investors. The more capital a firm has to invest, the larger the commissions and fees such investing generates for dealers, for bankers, for intermediaries and finders. And this creates the likelihood of receiving that all-important first call when an asset becomes available for sale. And the greater the amount of money and say the stock that a firm can borrow, the lower the borrowing cost it pays and the higher the rebates, the short rebates, I guess, it receives. So again, I could go on, but I guess you get the idea. So at ActiveAllocator, we think there are many benefits to seeing the multi-fund, multi-asset structure, and the movement to multi-asset management, I think, may be the next dominant trend. We are pretty well positioned for this as a multi-asset allocation platform. And I encourage you to check out www.activeallocator.com, where we show you how to holistically allocate to such crossover types. If you like what you see, get in touch with me. I'm Samir.Jain at ActiveAllocator.com. Thank you so much for listening in.